All right. So let's go ahead and go over some 8-1 questions real quick because it's due tomorrow at the end of the day. I extended that deadline through Wednesday. All right, so let's look at this kind of question right here. So this is asking for the finished goods inventory balance after backflushing costs. It has a zero balance, so all of this literally is asking is for the actual line in the backflush entry that goes to finished goods. So let's look at this FG entry after backflush. FG balance after backflush. And we already have our unit costs. So some nice kind soul took the total DM and the total DL and the total VOH and divided it by the 20,000 units to get us $15 per unit as our unit direct materials cost, $8 per unit as our unit direct labor cost, $5 per unit as our unit variable overhead costs. Now, one piece of finagling we have to do is we don't have in the numbers here the number of units in finished goods. But we can tease that out because we have all other units accounted for. So we know there are in total 20,000 units that we completed or that are still in process. We know how many we sold, so they had to have been completed as well. And we know how many are in process. So the remainder after those two have been taken care of out of 20,000 units has to be the amount in finished goods. So we have 20,000 total units less 17,650 units sold, because if they're in finished goods inventory, we haven't sold them yet. They haven't left. Also less 200 units in process. So we take 20,000, subtract away these two. We're left with 2,150 units. This has to be the units in finished goods because they've been completed. They're in the 20,000 we started with. They're not sold yet, and they're not still in process. So they've been completed, which means they're not in process anymore. But they haven't been sold yet. 2,150. Okay, well now we can apply our unit rates, that 2,150 number of units, and figure out how many dollars we're sending over to finished goods, what we're debiting to finished goods, which is going to be the same as the ending balance because it has $0 beginning balance. Okay, so we have 15, 8, and 5. What about that 7? Use it? Don't use it. Yeah, thank you. Good, because that's fixed overhead, and we are in direct costing land. We're using a direct costing rationale, direct costing definition of what product costs or inventoriable costs are, which means that only direct materials, direct labor, and variable overhead are counted as product costs. And I'm just going to sum these three and multiply that finished goods by that total right there. So this should be the debit to finished goods. And just for completeness, beginning balance of finished goods, ending balance of finished goods. I just took 0 and added that debit from our backflush entry just for completeness, because not every problem will have a $0 beginning balance. So far, so good, right? Is that okay? Okay. Anything you want to see? All right. All right, we've seen this one. Yeah. Here. Okay. Let's see if we can find after. Okay, let's try and find an open answer one. We don't have any open answer this time. We had a lucky draw. All right, let's look for it. First, let's make sure. Yeah, we got that question right. Good. So this one, but if it were after. Okay, let's keep looking. Oh, so this one. Is this okay? All right, great. Okay, so a firm uses backflush costing on a direct costing basis. It incurs the following costs this period. The firm has no fixed overhead costs. We have our direct materials cost, our direct labor cost, and our variable overhead cost. So in total, we have $50,000 of product costs, because under direct costing, all three of these categories are product costs. The firm's total units, completed and in process, is 1813. The firm has 59 units in process and 80 unsold units in finished goods. Okay. The firm has $217 of unused raw materials left over at the end of the period. What is the balance of the cost of goods sold after the firm backflushes costs to inventory accounts? Okay, so there's an element of timing and collection, and then calculating the backflush entry, or at least enough of the backflush entry. So let's look at this. This is open answer, aftermath, COGS question. So first of all, copy over our three categories, DM, DL, VOH. And so first trick is we accumulate costs in cost of goods sold using the backflush method when we're using the backflush method, which means that this before we do any backflushing, the balance is $50,000 in cost of goods sold. And we're going to credit a certain amount out of cost of goods sold to go back to the other areas. And I'm going to avoid breaking out the whole entry. When I did a similar problem like this last week, I broke out the whole entry to do every little piece. I'm going to do this in the more rapid fashion here. I know I have 59 units in process, and I know I have 80 units in finished goods. That's basically the idea. And so I need to get all the costs for 59 units in process and all the costs for $80 and 80 units in finished goods, plus the 217 raw materials, and that's what I'm going to be crediting out of COGS. So all I'm looking for ultimately is the final balance of COGS. In the actual entry, I'll have to split that in process up between the RIP line and the conversion cost inventory account line. But I don't, if I'm just looking at what has happened to COGS, cost of goods sold, I don't really need to know that. So let's get our rates here. 1813 total units. That's our denominator. And we can take that denominator and divide. We want total costs, right? We have our three cost categories here. We can divide total cost by total units, and that is the total cost per unit. And we're going to multiply that total cost per unit by in process, multiply the total cost per unit by finished goods number of units, and we can add in the raw materials. So this is total cost of in process, total cost of finished goods, raw materials we did by hand count. That should be the amount that I am going to be crediting out of cost of goods sold to its various locations. This will be split up between the IP portion of RIP and the conversion cost account, and then this will be added to the portion of the RIP line in the backflush entry. But it doesn't really matter to me right now for this question. So this is the credit to COGS. So don't just copy and paste this. Keep in mind what's happening here. Cost of goods sold has a debit balance because it's accumulated all these expenses. Expenses go up with the debit. and we're crediting away a certain amount from COGS here. So the difference between these two is the COGS after picture, if you will. COGS after backflush. COGS balance. Okay, I think that should be the answer if I've gotten everything copied over all right. Which cells do you want to see that again? Yeah. Yeah, I'm just taking the number of units from the problem times the total cost per unit for the two different categories of unit. Yeah. Just summing those three. Okay. All right. Other problems you want to see? That one, you said. Okay, this one right here. So Lava Pocket LLC uses backflush costing to assign product costs to inventory and values inventory using direct costing, which means what we value as inventory, what we consider out inventory to add to the value of inventory is defined using direct costing method, which means the three that I've given you here are all three product costs. All actual amounts are equal to budget amounts. The firm has no fixed overhead. All right, so these two sentences are just there to help you know there's no funny business going on. This is a simpler problem than you might otherwise think. Those sentences just try to help you not overthink the problem is the idea. All right, so here are our numbers. Let's come back to those in a minute. Also, not only about dollar numbers, we have the total number right here, 2,000 units. All right, Lava Pocket has 350 units in finished goods inventory and 250 units in process. Firm does a count of raw materials and finds 31,250 as the raw material of dollars in raw material inventory on hand at the end of the period. Okay, which of the following is the cost backflushed to the conversion counts account? So this firm uses a RIP account, a conversion account, conversion costs account, and a finished goods account. So instead of raw materials, WIP, finished goods, it's split up as RIP, conversion costs, finished goods. And I'm asking for the amount that's debited to here, backflushed to conversion costs. All right, great. So all we need to do is figure out what we need to do. And say all we need to do, like it's super easy. If this question confuses you, you're not going to feel that way. We need to take these conversion costs in the numerator and divide them by this denominator. And now we have a rate. And then we can multiply that by the in process. So when it says the RIP account, it means direct materials, raw, and in process. And when it says conversion cost, it means conversion costs in process. There's kind of a missing term in each of those inventory account names. But if that helps you think about it. So we need to look at the in process number. That'll be provided here. So that hopefully that is a cue that will help you pick out the relevant information in the problem. All right, so we have $250,000. We'll go over to the handy dandy Excel. We have 150,000 direct labor, 100,000 variable overhead, which means we have a total of 250K conversion costs. 2,000 total units. Take some division. $125 is our conversion cost per unit. From the problem, we have 250 units in process. We can multiply that rate by the number of units in process, and we get 31,250 as the conversion cost of units in process. And so that's going to be the amount we backflush to the conversion cost inventory account. Make sure I copy everything over right. Not missing anything. Okay. Yeah.
Can you differentiate between what we did here and on the last problem? Just roughly.
Yeah. So with the last problem, so this is the easiest way for me to think of it in my mind. We're teasing out different parts of the entry. With the last problem, really we were looking for the credit to COGS. So we just needed total amounts. What total were we debiting? Because that's what that has to equal, so it will balance. In this problem, we're just looking for the debit to cost conversion costs here. We did. We just lumped them all in together. And the last problem, we have a portion of this 1627 is debited to conversion costs. So it's debited to RIP right here. Some of it's debited to conversion costs. We didn't care. We know that in total, it's 1627 plus the R portion 217. But in total, we got the right number because really we're looking for this. We were driving at that. So that's why these two are a little different. I find it useful to start at the idea of the entry, or often to use the entry as kind of a guiding point. I know I'm going to be backflushing. That's the name of the method. So the backflush entry can sometimes help me navigate what's the simplest way to solve the problem. Does that help at all?
Yeah.
Or make sense to answer the question? Yeah.
So the problem that said backflush to the RIP account,
Mm-hmm.
we just do the direct materials and the variable overhead, not include the direct materials?
We just do the direct material. So let's solve that. Let's actually solve that. So now let's look at what if it's asking for this instead, the backflush to RIP. So RIP has two parts, the part and the IP part. What if RIP? So 500,000 would be DM cost. We can take that 500,000, divide it by the total units, same as before, and now we have DM cost per unit, or unit DM cost. Okay, we still have 250 units in process, so we can multiply that $250 amount of direct materials cost per unit times the 250 units in process, and we get 6,250. That's the direct materials in process portion, the IP portion of the RIP entry. And it's very tempting to just push that button. But we also have to remember we have the portion, which was 31,250 from here. I know that number also matches what we did right here. Ignore that. They don't have to match that. That's if anybody's getting confused there. I got that number from here. So the same number because I probably was lazy in wanting to check my math. So I'm like, let's make it all very similar and easy to do.
Well, my person just said 0 in raw materials.
Oh, well then you would just be able to stop right here. Yeah. But if there's something, you add it in, and this is the debit to RIP. Does that work? Yeah. So I'm taking the DM cost per unit times the number of units in process. Okay. How about maybe one more question? Does that really make people worried if I say just one more question? Yeah.
There's one that asks about like a balance on May 15th and June 15th. What's the balance?
Yeah, like this similar at least. Yeah, here it is. If you are in this category, so this is very much a timing question. This question is really drilling you on understanding the timing of backflush. And that's kind of giving away a bit of the punchline of the question here. So the idea here is, all right, so let's start at the question stem. So if you search the RIP account balance on May 15th, as in like searched in the SAP or QuickBooks or whatever they're using, on May 15th, and then again on June 15th, what would the searches show? So on May 15th, that's in the middle of May, no May backflushing has happened yet. That happens at the end of the period. In this case, we're talking about months. And that's always what it's referring to in this chapter, period. June 15th, we'll have whatever changes we had to the RIP account in May. And so let's look at what this timing says. So Harrison's Limited uses backflush with direct costing basis. Okay. At the beginning of May, the firm had $0 in all inventory accounts. Okay, so RIP has to have a zero balance on May 15th because no matter what we did during May, we could have spent $1 million on raw materials on May 1st, 2nd, and 3rd. They have been stored in cost of goods sold. Those costs are accumulated over in COGS. At the end of the month, we're going to backflush a certain portion back into RIP, conversion costs, and finished goods. So zero, it has to be 1 or 3 here. All right, and then we have some information here about May 5th. We purchased 100 units of raw materials for $5,000. Uses 90 units of raw materials. You think $500 of raw materials in the warehouse at the end of May. Okay, so if we had to, we have total cost of raw materials here, and we have the fact that we have $500 left over at the end of May. Total number of units completed and in process is 200, and 20 of those units are still in process. All right, so for June 15, we already have to figure out how much was backflushed at the end of May to the RIP account. And we can likely tell there's a $500 difference there. The professor's probably testing us whether we're going to remember the portion of the RIP entry. It's got to be 1, but let's go through it, double check. Let's call this, name of the firm, Harrison's Limited. I hope that's not referring to Harrison Ford. He'll never die. He's not limited. Wow. Nothing. Well, I know. I was going to say something, some follow up along the lines of, you must have seen Indiana Jones 4 because you know for sure he has limits if you watch that. $5,000 direct materials. I'm trying, man. I just keep swinging for those fences. It doesn't work. And we have a total of 200 units. Yeah, total number of units completed and in process is 200. So there's looking for total number here, 200. Whoop. Because I need a rate to figure out how much I charge to the in-process units, the IP portion of the RIP. Divide, I've got 25 is DM cost per unit or unit DM cost. And we have 20 units in process. So this $500 would be the, I know what this problem is doing. This problem is a problem because I mentioned how we don't care about the double counting with raw materials. We usually don't. This problem, I forgot about that. I'm like, well, I want to make sure I don't double count. So I used 4,500 here. And I ended up with $450 as the portion. Here's what I did. I said, oh, well, we used 5,000, but we have 500 left over, which means I only want to include the 4,500 net of that we used this period in my numerator. We have not done that in any of the problems, any of the other problems. We've said we're going to ignore the fact that we're double counting raw materials because we just don't care. Caring is a waste. That's your lesson for today. That's what lean practitioners would say. Caring about that kind of stuff is a waste. But here, I wasn't a very good lean practitioner on this problem because I cared. I'm like, no, got to track that 500. Don't want to double count. So that's why this problem in particular, I wonder how widespread that split personality of mine, deciding whether or not to care about it, goes. All right, so that's the if portion in this goofy problem. And the portion is given in the problem. We left $500 of raw materials, or we know there's $500 left of raw materials left in the warehouse. And so the overall debit is the and the if portion together for RIP, debit to RIP. 950. So it's that first, it better be that first one, unless I also had another brain fart while I was making this question. And just for completeness, make sure we incorporate there was no beginning balance in RIP. 0. This is June 15 RIP balance. Yep. I'm just multiplying our cost rate, direct materials cost rate, by the number of in-process units. Okay. I shouldn't have gone for one more question. That was my problem, see? You stop while you're ahead, and you don't come back and play for the Wizards. That's a deep. Oh, so I see. I got the reference. Good. Or no, that's even older. Never mind. All right. Okay, we good with A-1? Yeah. Okay. Sure. Like different, like that kind of this one sort of thing. Well, let's look at the details here. Is this look acceptable to you? Okay, good. Well, this one real quick. All right. Let's see. Firm accounts for which journal entry appropriately backflushes cost to inventory account. So first, let's just look at these entries and see if we can rule any out. Yeah, we can rule 2 out. You're not going to debit COGS. Your backflush entry should not be debiting COGS. You've been debiting COGS with your costs throughout the period because that means they're accumulating over there in that expense account. When you are trying to later backflush, you're trying to debit to inventory accounts. So they're going to go up with the debit. So you need to credit COGS and push some of that back to backflush some debit, a balance over there to the inventory account. So it can't be this number, this B option or the C option. It's got to be A or D. And I am looking at this one right here because it just happens to be $50 more in the RIP area. In fact, is that the only difference? Sorry, I scroll up and down all the time. Here. Looks like RIP is $50 more in A than it is in D, and conversion cost is a little lower in A than it is in D, and finished goods is a little lower in A than it is in D. So the RIP part would be consistent with Professor testing us on whether we're going to incorporate the portion, the $50 of raw materials. But let's double check. Look, Professor already gave me units. Do I include this 55 cents for fixed overhead? No, we don't. Good. Ignore those red herrings. Journal entry problem. All right, so we have 1.5 DM rate. That's direct material cost per unit. We have 2, which is our direct labor per unit rate. And we have 45 cents, which is our variable overhead per unit rate. And we have 250, I'll put them in order that it has there. 500 units in finished goods. And then 250 in-process units. So I'm going to start multiplying rates here. So first of all, let's get the finished goods, debit to finished goods. That's going to be the number of units in finished goods times the sum of all the rates. So it should be 1975. Looks like that's A and not D. So that's good. We could stop there. You could have stopped a while ago when you said, oh, well, he always tests us on that portion with RIP, so it must be A. Well, we now double confirm that it's A. Let's look at another one. Conversion debit to conversion costs. That's going to equal the units in process, because the conversion cost account means conversion costs of units in process. Units in process times the conversion cost related rates, which is direct labor and the overhead that we consider a product cost, which is only the variable portion of overhead, 45 cents. There. So 612.5, look, we've triple confirmed now. And now let's get the debit to RIP. We will say 50, that's the portion, plus the units in process times the direct material rate for the IP portion. So I've got $50, the portion, and those two cells, B82 times B77 as the IP portion for RIP. So there we go, good. And just make sure I didn't mess something up. Yep, it balances. COGS, credit, to balance it. So that's going to be A, yeah, for sure. You could have done any one of those three debit entries, just whichever one you find easiest to calculate in that case, to be sure and confirm between A and D. Whoa, I think I saw you first, Joshua. Debit to conversion cost, and then what else? Okay. Yeah, here I'm just taking units in process times these two rates right here. And then RIP, I do something very similar, units in process times the direct materials rate for the IP portion, but I have to remember that I also need that portion, which was $50 based on the problem. Okay. Who else wanted to see a cell? Is that what you were looking for? Oh, I just copied that over from the problem.
Oh, sorry.
Yeah, sorry. So it's that units times the sum of all three rates. Okay. Yeah.
So for conversion costs, we do direct labor, variable overhead,
Mm-hmm.
times units in process, and for RIP, the R portion, and then units in process times just direct materials. We never include the direct labor per unit.
No.
We did that for conversion, right?
Yeah. So we have to separate out those three. These three that are product costs, we're going to separate them out into a 1 versus 2 mix here. This is going to go to the RIP, and these two are going to the conversion costs. You wouldn't want to. In this case, we do make sure we don't double count direct labor and multiply direct labor by both of them. Otherwise, we put in the direct labor cost in process inventory in both of these accounts. So I guess we do care a little bit in lean, but yeah, to your question, yeah, we just with the RIP, it really means the direct materials that are raw and in process, not just every cost that's raw and in process. It's kind of the outgrowth of, instead of just the raw materials account that we traditionally have. Usually we have raw materials, WIP, finished goods. That's much more the traditional way of setting it up. We've converted that into RIP because we're going to track all direct materials in one account throughout the process till they're finished, is the idea, and value it that way. And conversion costs, we're going to value those as they're in process. You can't have those in a warehouse. You can't have direct labor or overhead stuck in a warehouse. They're periodic costs. I don't know if I said that just exactly right, but does that make sense? Yep. All right. Just one more problem. No, okay. No, we're gonna go to 8-2. We gotta move to that. All right, let's make sure we got these right first of all. We answered. So that's 6 unanswered. We answered 4 of them. And 12. Good. 12 points out of 30 means we answered 4 of the 10 right. All right, so 8-2. Now, there's not much to say about the throughput accounting aspect of these problems except do the same thing, but ignore direct labor and variable overhead, which means there's no longer a conversion cost account. You have a RIP account and a finished goods account. Those are your inventory accounts. What I would like to do is take us through the capacity variance idea. So, the basic idea is that there is such a thing as idle waste, and it is significant enough that we should concentrate the line of sight of the firm on it. And what do you do that? How do you do that? You generate numbers and report them. That's how a firm puts line of sight and interest on an idea or a topic or a decision by quantifying it and then reporting it. And that naturally that lends itself to then incentives. Well, okay, you can't get your bonus until you reach a certain level of achievement on this measure. So Lean cares a lot about this because we have all these fixed costs, which we care for separately because we're worried about direct costing. We don't consider fixed overhead to be a product cost. And even more so, we have fixed costs in throughput accounting. We consider direct labor and overhead, variable overhead even, to be a fixed cost because really they don't vary that much from time to time, except periods of significant layoffs. Like if you were in the corporate office of McDonald's this week, you really don't lose all that many salaried jobs. You don't cut that cost very often. At least not. It doesn't go up and down with volume in such a way that you really could treat it as a variable cost. All right, I'm kind of drifting away, but the basic idea here. Let's get back to the idea of capacity. How do you define capacity? What is your capacity? Now, I mean, I say you, unless I'm going to use this example as students. And I think it's worthwhile. I think it's a good way of talking about it. And I think also the zeitgeist of what I said also is important. So think of what is your capacity. And suddenly when I say, well, what is my capacity? Now that helps the emotions come into play, which maybe helps us see that there are multiple definitions of capacity. Because, if somebody asks me what's my capacity in something, my emotional view of that thing might color my answer to that. What is my capacity in that thing? So, for example, if it's something I really value, I might feel really proud of the capacity I built up. I'm like, no, I have high capacity for that. If it's something that I'm worried I won't do well at, I'm going to start hedging my bets and lowballing. Be like, oh, I'm not very good at that. It's okay. So to hopefully get myself a better situation, hopefully get myself so that I can meet or beat the expectation I set. And so what my capacity is, what I might describe my own capacity will vary depending on the circumstances or the area in which we're talking about, specifically the emotions and the intent that I have. And so naturally, we want to drill down when we're trying to put numbers onto capacity to what are all the definitions of capacity. We got 5 of them. They start from the most theoretical, I think it's in the name, the first one, to the most empirical. All right, this is the distinction that means a lot to me. And I'm going to use that word a lot, empirical. But I want to explain what I'm saying when I say that first. So theoretical means I've used I have looked into the future using my brain to say, well, I think this is what's likely to happen using all these different presuppositions and arriving at a conclusion. It can be done entirely on paper. Empirical means going out and observing nature as it is. So a mathematician tends to be very theoretical. A biologist is often very empirical because you have to go out into the jungle to observe those animals directly, or you have to go see what the actual complex system the biological complex system you're observing is doing. In accounting research, this isn't relevant to you, but maybe it helps inform it. You have variety of strains of research. One is very theoretical, where they just go through economic models of why people would report the way they do, why information asymmetry would match up the way it does in terms of, say, whether I report honestly or not in my financial statements. And they come to a conclusion. Well, likely you're going to find an equilibrium when this long equation is satisfied or whatever. So it's very interesting to mathy people, but also very removed from reality. And on the other hand, you have people who are very empirical. On my side, we do empirical things in terms of we get responses from real people. Like I had that study that a number of you may have participated in, and you go through and you answer some questions. So real people answer the questions. Also, there are people who are called archivalists, and they go through 20,000 records, 100,000 records, maybe, if you're getting a really big sample of financial reports, and saying, well, when I statistically analyze these, they go in a certain direction. When the company does this, the reports go up this way, or they go down this way, or these two things interact in a certain way. But it's taken from actual companies' reports. It's very empirical, taken from nature. So the basic idea is observation versus kind of reasoning it out. All right, so capacity has 5 different definitions, starting from the very most theoretical all the way down to the most empirical. There's a big gap between number 2 and number 3, where you jump from purely theoretical to empirical. So the top 2 are theoretical, bottom 3 are empirical. The first is theoretical capacity. So it's the maximum theoretically possible work that a machine, team, or process can perform. And the most ideal, impossibly ideal, it's almost always an impossibly ideal set of circumstances. So here is the example that I have. We have a class. Let's say a class meets for 1.5 hours a day. So we don't have that. We have a 1.5 hour class with the 15 minutes extra to get between classes. So that's great, but we only meet twice a week. This is actually more involved than what we're doing here. This is once every day, an hour and a half class. And I had a class like that once. I met every single day, and it's very, very intense. Like double the credit hours compared to usual. And so your theoretical capacity for classes then would be 16 of those classes. That's 16 6-credit hour classes. Let's look and see. Let's put that in Excel here real quick. So we started with 24 hours a day, 1.5 hours per class. $16 classes per day. So that's your capacity per day. You can take 16 classes per day, theoretical capacity. And of course, if that's at 6 credit hours per class, that's 3/4 of your degree done in a semester. Well, that is one issue. That is one issue. Yeah, it's a very particular kind of crash course class that is 6 credit hours. I mean, we would have completed all of our class meetings last month sometime if we were doing it. 4 days a week is really what we're talking about. Not even every day. But yeah, no, we don't know that many. And so, any of you been here for longer than a semester and a half? What's taking you so long? This is your capacity. 96 credit hours a semester, right? Okay. The emphasis on impossibly ideal. What are some things we're missing? Sleep. Oh, you guys still do that? We're sleep. Okay, you got to sleep. All right. So we will revise, and we will get a practical capacity. So okay, you have been heard 24 hours per day, but you need. Oh, I'm not yelling. But you need some sleep. I'm even going to let you be healthy and have 8 hours of sleep, unlike what some of us do sometimes, which is not 8 hours of sleep. So, okay, I'm very magnanimous here. These are the hours available per day. If I could spell it. There we go. And we'll see what we can do now. All right, there we go. 10 2/3 of a class every semester. 6 credit hour classes, so 64. All right, so you should be done in 2 semesters then. 120 credit hours will be done in 2 semesters. How many of you have been here for longer than 2 semesters? Oh man, I didn't realize we had such a lazy class. That's not unusual. That's not unusual. Yeah. All right, so we built practical capacity. Okay, I'm trying to make a point in this kind of dumb joke. I don't want to belabor it too long. So even though we have refined it, all right, let's even refine it further, because you don't just need sleep time. Does anybody eat? Sometimes, okay, yeah. So let's add a couple hours of sleep time. All right, so now we got it down to you should be taking 9 classes a semester that meet every single day, and each class meets every day. So we have moved closer to reality by incorporating realistic downtime. The downtime is the key word, and it'll be important for the questions. The idea is letting the machine work and have necessary maintenance. Letting the machine rest, or let the person rest and have any necessary maintenance. So I put in sleep and food, and that's gonna give us our practical capacity now. Usually the categories that move us down from theoretical to practical are the rest and maintenance that are required, the downtime required. Okay, great. Now, I actually want to go from the bottom up now, and we'll meet in the middle. So let's go to the bottom, which is the actual capacity. And so if I asked you how many classes you are taking this semester, I'd get answers like, well, this is my only class. I'm doing something else. Or, I'm only taking 2, I'm only taking 3, or 4, or 5. I think probably would get, on average, usually we have people say that about 4, maybe 5 would be the average, depending on how quickly people are trying to get through. And so that's your actual capacity. It's an empirical observation of what's actually happening right now. Great, this period. And then I could also ask you, well, let's move away from actuality a little bit into hypothetical land and say, well, how many did you plan to do this semester? Maybe you planned an extra class, but you got there the first day and the professor was all weird. Well, all right, I don't know where the joke is going, but that's the idea. And you dropped it. So your budgeted capacity maybe was 5 classes. You budgeted in, I was going to do 5 classes this semester, but my actual capacity this semester, I ended up with just 4. Maybe that's the case. And so now we have that kind of a difference. This is a little more hypothetical. It was our plan before the rubber met the road. But it's still a plan that was very realistically based. It's informed by what you actually thought you could accomplish and whatnot. So very empirical. And the normal capacity says, okay, well, let's try and iron out let's try and even out the differences, smooth out the differences, and say how much is usually done. What is the capacity usually, in the last 3 to 5 years or so? And so if I took a poll of everybody in the class, how many classes are you taking right now, and then I averaged that across all the semesters in the last 3 to 5 years that I've taught, that would be the normal capacity. I would say, well, the normal capacity for students is that they take 4.25 classes a semester, or something like that. All right, so I've now generalized it across time to try to smooth out any bumps in. Well, the professor was weird, or this semester is weird, or I took a lot of classes this semester because I want to get done, or whatever it is. Okay, and then we have this big gap between the bottom 3 empirical definitions of capacity, 1, 2, 3, and the top 2 theoretical definitions of capacity. So this is a very important and big gap, but they all have gaps ultimately. And those 4 gaps, because if you have 5 points, you're going to have 1, 2, 3, 4 gaps between them, are the capacity measures that I took these names and I give it credit. I don't think I'm doing anything wrong by taking their names. It's just names from practice of these 4 types of waste, of idle capacity waste, from Management Accounting, an Integrated Approach by McNair, Connolly, and Merchant. I think it might be Merchant, actually. He's a relatively well-known accounting professor, and relatively is the key word in that sentence. How well-known are accounting professors, really? But among accounting professors, yeah, it's kind of a big deal. So we have 4 of them we can do. We can say, let's put the 5 definitions up here. We have theoretical capacity, practical capacity. Oh, I wasn't going to write capacity every time. And then those are the 2 theoretical versions. And then we have normal capacity and budgeted capacity and actual capacity. And so between these 2, we have what's called rate-based waste, meaning the fact that you have to sleep 8 hours a day cuts down your ability to take classes. But it's true. It's true. Or, class isn't the best thing. It's a necessary evil, perhaps, in your life. I don't know. But if you are engaged in a job you really like or that pays really well, you might say to yourself, man, if I could cut out sleep, that'd be worth it because I'm making bank. Or I really love this thing, or whatever it is. But the point is that downgraded capacity, because you have to sleep or you have to eat or whatever it is that's the necessary downtime for your productivity, is a type of waste. We're going to call them all waste because that's what they always do in Lean. They call everything waste. And in a way, it is. But we'll come back to that in a second. Next is management policy waste, and that bridges the theoretical capacities to the empirical capacities. So management policy waste, with the idea being that if we optimize management policies, we could get our normal capacity as close as possible. We could narrow the gap between the practical capacity and the normal capacity. So, for example, when the university sends out emails reminding you that, hey, or advertisements somewhere that say, hey, summer classes are great, you should take some summer classes. They're trying to push, it's a policy that they've implemented to try to push you towards increasing your capacity by increasing the number of classes you take in the summer. And I'm sure they have financial reasons to do that because they make incremental profits off of you taking summer classes or something like that. But they are trying, that is a policy that would narrow the gap. It would increase the number of classes a student takes in a year. All right, we'll come back to that as well. Budgeted waste. All right, so budgeted waste is between normal and budgeted. When you do problems on this, make sure you don't think it's between budgeted and actual. It's not. It's between normal and budgeted. It says, well, the norm is this, but for the upcoming semester or the upcoming month or whatever, I'm budgeting this, and this is why. And so insofar as they differ, insofar as your budgeted is lower than the normal, that's a form of waste. And maybe it's a necessary waste. So for example, let's say you usually take 4 classes a semester, but you've got an internship next semester or something. It's really important for your future career, so you're going to cut down to 2 or 3 classes, for example. You have budgeted waste in there. You have decided that trade-off is worth it. And then lastly, you have efficiency waste. And that's the weird professor that you decided to drop at the beginning of the semester. You budgeted a certain amount, but your actual did not come up to that. Somehow you didn't efficiently reach the budgeted level. So the idea is that these are always going to exist. There's always going to be these gaps. And these 3 might vary oddly, because sometimes budgeted will actually be higher than normal and sometimes lower than normal. Maybe your actual is sometimes a little higher than budgeted, a little lower than budgeted. These 3 tend to go closely together, and these two kind of go closely together. But there will always be these kinds of gaps over time, or they're very, very common or inevitable in most situations. And the lean practitioner wants to manage those, get line of sight on those, and if possible, over time, through what's the phrase from earlier, a process of continuous improvement, minimize those gaps. Yeah. Negative waste? I don't know. It's a good question. I don't know for sure the answer. I bet it differs when depending on the lean practitioner, because there are no rules in it. But yeah, that would not, it wouldn't be right to call that waste, would it? Maybe you'd call that a windfall of some kind. Windfall is a very academic sounding name or odd sounding name. You might change the polarity of the word you're using. In chapter 7, we had a very neutral variance, which we varied, right? And the naming of these tends to be a little pessimistic, that we're always going to be budgeting below what we should, and we're always going to be inefficient, below what we budgeted and whatever, and so we're just going to call it waste. But you're right, we could theoretically be higher. And I'm not sure what they do. A negative waste, a non-waste. I could get back and see if I can find any references about that. But good question, yeah. So the questions are going to ask you basically to identify these 4 wastes, and it's primarily a definitional set of questions that ask that you have to worry about. It's not really hard math. Maybe conversion of units. So like making sure 24 hours in a day, and that kind of making sure you're comparing apples to apples is the idea. Let's jump into a question so I'm not just talking and you're like, well, that's all great, I guess. It's blah-de-blah. Let's look at some of those questions. The oh no way question is here, is it? We're going to have to go over how to do that one. This didn't show up in chapter 3, did it? Okay, so I successfully moved it out of there. Some semesters, perpetually, I attempt to, or I forget to, or whatever, it ends up in chapter 3. And I've moved it successfully, I also need to go over how to do it. All right, capacity variance questions. Okay. So affirm budgets that a department will produce a total of 19 units every hour. Due to the success of implementing lean practices, the department has produced 20 units per hour. What is the efficiency waste for this department per day with 24 hours per day? All right, so here is an example of like a non-waste, an anti-waste, call it. Because, clearly something is anti-waste here because we have 19 as we budgeted, but we produced 20 per hour. Here is another key. I just jumped to that idea that that 1 unit difference must be the waste we're talking about. Efficiency waste. Let's see. Is efficiency waste? Yes, it's budgeted capacity less actual capacity. Good. I've got the right one. So we're going to be tempted to say 1 perhaps, but these are units per hour with 24 hours in a day. So the efficiency waste per day is 24 units. And we're just going to put an absolute value because these are focusing on the definitions. Can you get the right waste definition? All right, let's look at a few more here. Here's one of the few conceptual questions. So chapter 8 has some conceptual questions. 8-1 has them about value stream income statements. 8-2 here has a few about capacity variances. So which of the following best describes why capacity variances, also known as idle capacity waste, are covered alongside lean accounting topics in the textbook. There's no good reason the professor just big meaty face. Oh yeah, let's check that one. Because variances, along with traditional standard cost-based variance analysis, are critical tools in lean accounting. Okay, well, because these variances, excuse me. The first part, lean accounting people do use these variances. I'll keep my train of thought going with that after we talk about another question or two. But they don't use the standard costing sorts of variances from chapter 7. They wouldn't want to use those. Okay, so it's not one, unfortunately. It's not one, it's not two. Because lean firms consider idle waste, because lean firms consider idle capacity as waste, these firms might use capacity variances in a similar way to how non-lean firms use traditional variance analysis. That actually sounds like a decent summary of the idea of capacity variances. Let's check to make sure. Because lean accounting is interested in hiring workers at the lowest wage possible and keeping those busy as much as possible. So that contradicts the initial ideas of chapter 8. We understand that there are some costs like quality in lean, we the lean practitioner understand there's some costs like quality that do drive up the cost function, but they also drive up the revenue function. They're part of the value stream of providing value to the customer, which is the reason you're in business. And so you don't just want to pick randomly the lowest wage possible for workers and work them to death. That seems unproductive. We're acknowledging the fact that you're going to have some level of idle capacity, but you want to, over time, economize those through a process of continuous improvement. All right, so it's going to be C right here. All right, let's try this one. This one's not going to be a weird one, which is like anti-waste or something like that. A firm has a machine that can produce a unit every 5 minutes. All right, we've got to figure out how many minutes are in an hour and a day, too, right? The machine supervisor thinks, I think I had a problem like that, a typo like that I fixed on a different question. I didn't get this one. Thinks. The machine supervisor thinks that the machine needs 20% for maintenance. What is the management policy waste for this machine per day? How do you think we can solve this problem? Let me get these both instances up here so we can look at the problem and at the definitions. Yeah. Okay. I like what you're saying. So there's one caveat here. So normal capacity is the work usually done. Like over the last 3-5 years, workers usually get this much done. The machines usually get this much actually done. So it's an empirical measure. If we take the machine that can produce every 5 minutes, at least ideally, and then cut out 20% of it for rest, is the idea. Maintenance. What we've done is we've gone, that puts us from theoretical to a practical capacity. We can calculate these two. The theoretical capacity is a unit every 5 minutes, which is what? My brain's going to fail me. 12 units per hour times 24, 288. Yeah, it should be 288 units per day, which is one of the answers. That's a theoretical capacity. And multiply that by 0.8 for maintenance. That would give you the theoretical capacity. Probably that 230.4 is what that's going to be. Oh, did I say theoretical? Practical, it would be 230.4. So let's look at this question here. And we're solving it as if, let me put a pin in here because there's a definitional problem here. So theoretical capacity, let's see, capacity variance question. Theoretical capacity is unit every 5 minutes So that's 12 units per hour times 24 hours, 288. Practical capacity is that with 20% downtime, so that times 0.8. And the difference between those two is 57.6. So that's going to be a waste. But the question is it management policy waste? It's not management policy waste, which is what the question here is asking for. We just figured out rate-based waste. So when you do these questions, I bolded the bolded parts on purpose to make it easier. The definition of that waste is going to be important, because just because you can calculate a number doesn't mean it's the right number. Maybe it's the wrong type of waste. We're not calculating that. Also, I bolded as many as I could. I think I remember to bold all of them. The per day, to make sure we've got that on the right units. So I think what you were going for was we need to figure out, well, the management policy, we need normal capacity so we can figure it out, because it's one of the two. Problem is we never got normal capacity. I don't know. Sure, theoretically, it can produce 5 minutes, or unit every 5 minutes, excuse me. And we also know it probably needs 20% for downtime. That's maintenance. We can go from theoretical to practical now. We don't know. Maybe in reality, over the last 3 to 5 months, 3 to 5 years, that machine has only produced a unit every hour for one reason or another. The normal capacity might just be 1 unit an hour. We have no information on that, so we cannot determine that. We can't determine the management policy waste. Okay, so those kind of capacity variance questions are going to have that typical challenge. Can I get it on the right units? To get a per day number, which is often, I think it's always phrased that way. And can I make sure it's the right definition of waste? I would suggest putting this line for each of the 4 wastes on your notes for the exam. So it's real easy to be like, oh, double check, is this the right waste? Yes, I can solve it, and this is how you solve it, theoretical minus practical. Okay, so what does a lean firm do? The last 4 minutes here, what does a lean firm do with this number? Well, it tries to minimize each waste, or get it to be anti-waste or negative waste or whatever as high as possible, right? In a sustainable way. So through a process of continuous improvement, excuse me. So for rate-based waste, we could take this machine that needs 1/5 of its time is down to 20% of its time as for maintenance, and find a machine that's more durable, so that we only have to maintain it for 10% of its time. So that would decrease, that would reduce the gap here. And technically that doesn't change these. You'd be hard pressed to tell me though that halving the time, cutting in half the time that it has to be maintained, wouldn't pull those up with it. So the idea is by reducing the rate based, the rate of maintenance and downtime, I can't pull these up over time. The lean assumption is that has to be true. Okay, so we're going to pull that up. We may want to over time improve reduce the amount of downtime. Management policy, we'll try to create management policies that bring our norms, what we normally produce, say how can we push towards what we theoretically with proper maintenance could do. So we're going to make management policies that will help narrow this gap, which will pull everything below up as well. Budgeted waste. Well, how can we set appropriate targets that don't deviate too far down from the normal? What can we do this period that we can set an appropriate target that maximizes what we can get through here, that will pull up budgeted. So for example, let's say I typically take 5 classes a semester, and I'm debating whether or not I will take that 5th class in the upcoming semester, because I know that I'm also going to be on the market looking for a job or something like that. if I were looking at this in a lean practitioner lens, I would say, oh well, I can choose, I can keep my budget at 5 classes so that I make sure I get all my classes in, I make sure I graduate on time. And so then if I have to drop a class, I'm not dropping from 4 down to 3 now. So let's say, for example, I'm tempted, instead of doing the normal 15 credit hours or 5 classes, let's get on credit hours, 5 classes, I'm tempted to budget 4. If then I had to drop one of them, I'm dropping to 3. If instead I say, no, let's hold firm, normal's 5, I'm going to budget 5. If I have to drop one of them, I'm dropping to 4. There's how you use fingers. Dropping to 4. So yeah, by reducing the budgeted waste, I've pulled up all the wastes below it. And lastly, efficiency waste. Well, okay, here's our budget. How can I execute? I almost want to always call that execution waste. Somehow I didn't execute based on the budget. Something happened I wasn't prepared for, or the machine wasn't prepared for, the workers weren't ready for, and the operational decisions failed somehow. Some sort of tactic failed. How can I improve that over time? All right. I think that's all we're going to talk about with that. We'll come back Thursday, do more problems on those problems. We'll talk about the Ono way problem. I think that's one of the few that has that kind of question in there in this test bank. And we'll go over throughput accounting backflash again.